Hi, I'm Pattu from FreeFinCal. Today, let's take a look at a question asked by a reader. I've been doing an SIP in the Nifty Next 50 for the last 2.5 years, and if I compare it with the Nifty 50 SIP in the same period, it has underperformed it. Should I switch my SIP from Nifty Next 50 to Nifty 50? So let's take a look at this question. I'm sorry I've not been able to make videos every day, or I think this is my longest break for a long time. Like I've mentioned before, I'm making videos for my semester course, and I'm packing a 3-month semester into a 1-month tight schedule, and I'm almost done with it. So after that, I will be able to continue this more regularly. So I've talked about the Nifty Next 50 several times, and the Nifty Next 50, although it's supposedly part of the large cap universe, it's a very volatile index, and it's got a volatility that's comparable to Nifty Mid Cap 150 or any mid cap index. And the reason for that is the impact cost. That is, if you take a look at the impact cost of the top 100 stocks, the impact cost is a cost that that's an intrinsic to the demand and supply forces of the market. If you try and sell a stock in large quantities, there will be a huge discrepancy between buy price and sell price for certain stocks, and therefore you have an impact cost. This impact cost is not because of any brokerage or anything like that. It's basically a demand and supply mismatch. That's called the impact cost. If you take a look at the Nifty 50, when they construct the index, there is a liquidity criterion for Nifty 50 stocks. There is no such liquidity criterion for any other index other than something explicitly mentioned as a liquid index. So the most of the liquid stocks of the Nifty top 100 would be in the Nifty 50, and there would be, if you go down the 100 stocks, the bottom 50 will have very low impact costs, and that's why they are volatile. So if you try and sell large quantities, that is by institutional buyers and sellers, there will be quite a big fluctuation in price, and that is the reason why the volatility is significantly higher. So it's not a large cap stock index. You are not investing in a large cap index. Don't make that mistake. Now, I had talked about the Nifty Next 50 in August 2016. That's like 4 years ago now. And one thing I noticed is that the increased interest in index investing over the last few years, it started with Nifty Next 50 because it became a 5-star fund, because prominently many active funds were not able to beat it. That was in 2016, 17, 18 period roughly. Then there was a lot of AUM flow into it. Of course, always retail investors look at the event, and after everything is passed, they will start investing in it. After the market started falling down from February 2018, the AUM still started flowing into Nifty Next 50. That's a different story altogether. We'll come to that in another video. So so that's one reason why there's an increased interest in index investing, and the other reason is that more people want to invest in Nifty and Sensex indices because they have also become 5-star, 4-star kind of funds after February 2018, when there was a big imbalance in the market. Few stocks in Nifty moved up, all the rest of the market were kind of moving down. That imbalance had reset itself after the March 2020 crash, but I think it's come back again a little bit, like I pointed out in a few videos ago. I forgot what I wrote. So it's basically return driven AUM. I mean, you can't be a successful index investor if you look at returns and say, oh, index funds are doing well, let me go and buy them. If you are having that kind of a mindset, you're going to be in trouble. The only reason you should switch to index funds is because you are tired of active funds, and you look at active funds and say, okay, today's star performer is tomorrow's character actor, and so on. You are tired of shifting among active funds, that you decide to sit in one fund and just manage the portfolio passively. That kind of a mindset, if you don't have, in my opinion, active investing will not work. I'm not saying you should not do active investing. I am very much in favor of active investing, but do it for the right reasons. And also, I lost my train of thought. All right, let's come back. Getting old. All right. So you should do it for the right reasons. Don't do it for returns. And also, please recognize there are many people who make a mistake saying just because of this market imbalance, active funds are not doing well. No, even before the market imbalance began in February 2018, I have shown that even before that, active funds struggle to beat passive funds, and only about half the category of funds, half the funds in a category were able to beat the market. That's a different story. So you have to be a passive investor for the right reasons. Now coming to this SIP performance, I have tabulated the SIP performance of the Nifty 100, Nifty Next 50 and the Nifty 50 for the last 1, 2, 3, 4, 5 up to 13, 14, 15, 16 years or so. All right. And if you notice here, for the last 2 years, 3 years, 4 years, 5 years and 6 years, the Nifty Next 50 has underperformed both the Nifty 50 and the Nifty 100 index. But it has kind of bounced back in the last 1 year. That's a good sign. And so because of this market imbalance where Nifty is more or less, kind of overvalued just by a few stocks moving it up, and therefore Nifty Next 50 looks like a poor index, and because of its long-term performance, you can see long-term SIPs have done reasonably well. There is reasonable or I should say there is a reason for you to believe, look, this is a temporary phase. Nifty Next 50 should do well, although it's volatile. I understand it's volatile, but this underperformance is not because of volatility. It's not because of that kind of a risk. It's because some stocks in the Nifty 50 have moved up too much. So I'm willing to wait for the things to correct itself, and then I think Nifty Next 50 should be a guaranteed high risk, potential high reward kind of option with respect to the Nifty 50. I had also talked about managing the portfolio. If you hold only about 5%, 10%, 15%, up to about 20% of Nifty Next 50, rest of it is Nifty 50, then you can do a systematic rebalance once a year. There is no problem. You can, there's no need to do, that is, I'm talking about systematic rebalancing between equity and debt. There's no need to do an additional rebalance between Nifty and Nifty Next 50 that I have already shown. There's no need to do it. You can see here that if you take about 15, 20, anything anywhere between 10 to 20% of this return and rest of this return, you will get more or less this kind of Nifty 100 returns. So, and some people have asked me, can I invest in Axis 100? Yes, you can invest in Axis 100. Expense ratio will be a little more, but that's fine. If you're okay with it, if you say my rebalancing costs will be compensated by that expense ratio, fine, then that's taken care of. You can go ahead and do that. Those who are investing 30%, 40%, 50% more than that in the Nifty Next 50, they should consider, in addition to systematic rebalancing, they should also consider some kind of tactical rebalancing, so that whenever there's a huge gain in the Nifty Next 50, you kind of whenever there's a huge gain, you book profit from it and push it safe elsewhere. When there is a huge drop, you can consider adding some money into it. That's a different matter. At least when there's a huge profit, you will not be psychologically affected, because you see 1 year the Nifty Next 50 has moved up by 25-30%. Next year it falls by minus 15%. You will not be psychologically affected if you had booked some profit. So that way, some tactical play probably is necessary for higher allocations in the Nifty Next 50. I have a tool for you to do it. If you actually go to the scroll back right up to the menu, there is a tactical buy sell tool right here. You can use that and make these decisions. I have already shown via backtest that it works for gold, it works for equity, it works for gilts, etc., etc. I will make a video on how to add data to it. I think someone asked me this. I will do that. So that's what I wanted to say. Catch you later. Bye bye.